we will talk about your fund.
Okay.
Last year was, we have seen dip in the February,
Yes.
peak just before the election, drop after the budget, and again several peaks in November and December. This
Yes.
volatility, how you used to construct your portfolio?
So, if you look at for constructing any portfolio, there are two things which go and which goes for the market, which is one is the hope, another are the facts. Okay. So what we saw in the market, where the market tried to peak itself, whether it was February, just before the election, there was a rise. There was a hope factor which was getting built up, right? Hope factor, the fact that the government will come in and will do certain things, uh, which unfortunately post that hope built up, the subsequent data did not supported that hope theory and the market corrected. But market remain optimistic about it and try to build in that hope again and again, and which has been the case for entire last year. And the data has been telling people, no, it is not the case and you need to correct. Now in this, typically if you look at it, it's become very difficult to adjust your portfolio every 2 months, every 3 months, because of the fact that the data itself is so volatile that you have to take a slightly long-term view. So when we talk of a long-term view, that means you have to get away from lot of assumptions, because the moment you go for a lot of assumptions, your hypothesis becomes a typical hope theory, right? And which the data is saying that you cannot have too much of hope theory, because again and again it is defying itself, right? So as a result, you have to then look at more sustainable stories, more stabilized business, and that typically will mean that few large cap stocks, right? And I think everyone did the same thing, and that is how the money got concentrated to few large caps, and we saw the valuations of those
Stocks
going up. And why only few? Because the large caps are
limited, up to 100 only.
yes, but then the things were restricted only to say 15 stock, 20, 10 stock. I'm saying slightly liberal thing, but because when I looked at this with the same parameters, out of 100, I only found some of them showing or maintaining their earning trajectory, maintaining their business outlook, delivering on the expectations and all those kind of a thing. So I started giving, as an investor, premium to that. And market continued to see inflow, right? So the liquidity was there. Even the period when the FIs were going out, the domestic flows were sufficient enough to take care of that. So if you look at, it was not that the money on the net basis, that the money was getting sucked out big time. If that would have happened, maybe these stocks also would have not seen what. So the liquidity plus the numbers plus the safety, all of that added to this. And now basically, if you look at going forward, though they are expensive on the historic valuation basis, on the absolute valuation basis, people are still holding on to them because they are not seeing credible numbers coming from the other side of it. And till that does not happen, so people don't get convinced about it, it will continue to say to do the same behavioral pattern. However, there is one more thing which has changed between the start of the year 19 and the start of 2020, and which is very, very important, is that between this year, the central banks globally, including RBI, has gone on the easy monetary policy, right? So everyone has started not only cutting the rate, so almost all central banks have cut rate in last 1 year. Also, they have increased the liquidity in the market by doing whatever operations you call that. As a result, the market is now sitting on high liquidity, and that liquidity is increasing. Historically, if you look at such liquidity, after some time also find places to countries like India, other commodities and all those kind of a thing. And we see those also getting supported by the liquidity, right? So I think going forward, you may see there's a lot more money coming out from the offshore side. If the domestic continues, I think if the numbers comes in, the recovery could be very, very sharp, right? So which will mean that you will not have time to actually
re-enter into market.
right. So basically you have to keep on analyze
Invested.
and keep on, as an investor in fund manager, we have to keep on analyzing, remain invested in the good stock, keep on. So that is a continuous process. I cannot keep it that okay, I
Cash
will.
call are not permissible.
I don't think now is the time for the cash
For cash call.
cash call. You should have more structural thing. And as a fund house, we really don't believe in cash calls per se. If you look at, because I'm charging a management fees, right? A cash call can be taken by the investor himself, right? By redeeming and the
Switching to liquid.
whatever it is, and the transaction costs are not very high, right? So what's the point in and
Taking cash call.
so basically there is an investor who has his objective of doing things. Then there is an advisor who has, based on that risk profile, done that distribution, whichever it is. Then if I, as a service provider, I also start doing
Cash call, then
that entire dynamics on which it was building up has. However, that does not mean that you cannot take for some time, but it cannot be a strategic decision. It can be a tactical thing, which is fine, but taking a strategic decision and running 20% cash, charging 2% on that, I really don't.
the sectors which you like.
So currently we are
Overweight on.
so we yes, financials is something which we are overweight, and which primarily is the fact that if the economy does well, then the financials are the one which comes, get the biggest multiplier. Also in 2019, the financials have also seen their businesses stabilizing, right? The NPAs or
NBFC crisis.
yes, everything put together, that is coming to a rest. All that which was disturbing the market in terms of NPA crisis, incremental NPAs, your pricing issues because of the the liability being expensive. You've seen the liability profile getting. There are new angles which have come up, but I think overall, if you look at this sector, has stabilized and more so, and you are able to now distinguish which are good companies to back, which are bad companies to weed out. So I think that is one which we are quite positive. Other sectors which we are overweight would be something like IT. We are underweight right now. Chemicals we are overweight. Pharma we are overweight, but we are more overweight on the domestic pharma companies.
Metals you are overweight.
Metals, we would be, I think, neutralish or slightly underweight, but we are positive on industrials. Okay, industrials also more of the product companies, right?
Bearing, etc.
Yes, those kind of a thing, which not like the normal. So in chemicals also, if you look at, we are not that positive on commodity chemicals, like soda ash and things like that. We are more on the
Chemicals business.
specialty chemicals, which have seen decent stabilization growth in last 2 years, if you look at. So these are the few things which we are, away from the crowd kind of a thing. If you look at not banking that much, because most of the portfolios you will see positive on banking, but I think chemicals, industrials, pharma, I think these are the three bets which we are more positive.